Hey folks, Chris Versace here. It is Monday, June 9th, and this is our look at the week ahead. Now, anytime we want to take a look forward, we always have to kind of take a quick look at what just happened. In this case with the market, we closed out last week with the relative strength index levels, or RSIs, for the S&P 500 and the NASDAQ composite continuing to chug higher. Not yet overbought. That would be a index level at 70 or higher. Not there yet. But again, over the last couple days, they've continued to chug higher, and if we continue to see the market melt up, we'll want to pay close attention to those RSI levels as it does so. At the same time, when we think about investor sentiment, it is flashing greed, according to the Fear and Greed Index. Now, why is all this important? Well, a couple things. Given some of the events that we have unfolding this week, most notably, and I'll talk about them in a second, the start today of U.S.-China trade talks and Apple's WWDC event, it's possible that the market continues to melt up today, tomorrow, ahead of the inflation data that we'll start getting on Wednesday. If that happens, and we see the RSI levels, approach or almost kiss, if you will, the level of 70, and we see investor greed go from just greed to extreme greed, could be time to become a little more cautious in the marketplace, like I said. But let's talk about these 5 items, beginning with economic data. Coming off of last week with the ISM PMI data for May and the May employment report, ADP's May employment report and all that, a lot of signs that inflation pressures, whether they're input costs, output costs, are on the rise, or wages accelerated compared to the last few months. So all of that kind of sets the groundwork for the May CPI and PPI reports that we'll get this week. Both the CPI and PPI reports are expected to tick higher on a sequential basis. Again, not much of a surprise given all the data that we've received previously. Now, as these 2 reports roll in, what are we likely to see? I think folks are going to be revisiting Fed rate cut expectations, which surprisingly, according to the CME FedWatch tool, are still hovering around 3 25 basis point rate cuts for this year, really from September through the end of the year. But we've already started to see Fed officials signal that they might see just 1 rate cut. And I think as we get this week's data, including the CPI, PPI reports for May, but also the preliminary June consumer inflation expectations report, which measures just that, what do consumers think inflation is running at? And candidly, that has been running hotter and hotter over the last few months. February, the findings were up 4.3%, March 5%, April 6.5%, May 6.6%. Now, again, when we map it against the other data we've already gotten, it's likely that it's going to move higher with this preliminary finding for June. But we also have to remember 2 things. First and foremost, we have seen oil prices come down, and that has translated into falling gas prices. According to AAA, the average gallon of gas in the U.S. is around $3.12, down almost 10% year over year. Now, that could lead some people to think that consumers who tend to vote with their pocket might see not as high inflation expectations in the preliminary June data. But let's remember that we have heard a number of companies talk about the need to increase prices as a result of what they're seeing on the tariff front. Some have already started to do so. Others are taking a more familiar tack of shrinkflation. That's where you pay the same, but you get less. And if you've gotten a bowl recently at Chipotle, you know what I am talking about. So we put all of this together, and the reality is we're likely to see the inflation data not be very conducive for Fed rate cuts. We suspect that when the Fed unveils its next set of updated economic projections on June 18th, it's likely to show 1 rate cut in the back half of 2025. Remember that back in March, the Fed telegraphed 2. That was really before the impact of tariffs and the uptick that we've seen in the ISM data, in various other areas of inflation tracking data as well. So That could be kind of upsetting to the market, which again continues to pencil in 3 rate cuts. Let's move on to our second topic, U.S.-China trade talks. They are slated to start taking place today. Given the timing, we could see some headlines this afternoon. Likely topics are technology and export controls, rare earth elements, and student visa. Now, are we hopeful for some forward progress on this and what it could mean to jumpstart trade talks with other countries, other blocs, the European Union, Japan, and the like? Sure we are. But our view is that trade deals take time, so we should not expect anything imminent. And when they are finally inked, it's the details that matter most, not the initial headlines. So, again, likely to take time. We're going to be patient on this. And as the dust settles, that's when we'll start to figure out what's really going to happen. But do we realize that President Trump is likely to declare a victory no matter what? Yeah, probably the case. But again, we will wait and see how this develops. Same thing goes for Trump's big, beautiful bill that it's winding its way through the Senate. So a lot more to come on those things. Earnings, number 3. Yes, hard to believe that with 3 weeks to go until the end of the quarter, we still have these things trickling in. But there's a couple buckets here. J.M. Smucker, Dave & Buster's, Victoria's Secret, and RH. Comparing, contrasting those comments. Those will tell us a lot more about the consumer. From our perspective, we'll be thinking about them from our cash-strapped consumer model and our luxury buying boom model. The second bucket is really Adobe and Oracle, cloud and AI. We'll be paying attention as it relates to our AI, digital infrastructure, and cloud computing models. That brings us to number 4. We do have another wave of investor conferences this week, and both we and Wall Street will be mining those company presentations for the latest on not only the current quarter, when it comes to thought on input costs, pricing, hiring, margin pressure, and demand, but also those things for the second half of the year. And that will help solidify the picture for earnings expectations, not just for the S&P 500, but really for what sectors are poised to deliver superior earnings growth, which ones might need to see earnings expectations revised lower. So I think that's going to be another big thing to watch, especially as we start to get closer and closer to the end of the quarter. And finally, today we do have Apple's WWDC event. It's going to kick off with the company's keynote address later this afternoon. And historically, the keynote address has been kind of a big thing for folks to watch, even though it's more geared towards developers than it is for investors. And this time, based on the things that we're seeing, hearing, reading, it sounds like that this could be a bit of an underwhelming event this year, as the company is focusing much more on overhauling the look and feel, design with its various OS platforms, iPhone, iPad, Mac, tvOS, macOS, visionOS, to make them a little more cohesive, if you will, similar look, similar feel. From our perspective, the real question is, what does Apple say about AI and Apple Intelligence? There are likely to be some announcements on that front. We'll have to wait and see. There is some speculation that Apple could open up its models to the developer community. That could be a very interesting development, and one that will be worth fleshing out. But we'll be paying attention, not only given our AI model, but also our digital lifestyle model as well. And that, folks, is our roadmap for the week ahead. Be sure to check back during the week for more, much more, and we'll cap the week off, as we usually do, with a look back on all the signals that we've collected for our various models. Thanks for watching.